This week we've seen quite good encouragement from the markets, showing us that the recovery that we've expected pretty much looks as if it's well underway. The markets are telling us that commodity prices have risen and will go higher, and we're particularly encouraged by the way the gold price in US dollars has been strengthening again as we had expected. The A dollar has been very strong, and that in itself is a good confirmation in a big market that the recovery is underway. The driving forces are clearly the international stimulus that's gone through from the US, from Europe, from Australia, putting money into the system in various ways, and the net effect of this must be to increase investable funds, which will really flow into equity and commodity markets. The gold price, as I mentioned, does seem to be indicating that we're going to see prices well over $1,000 in the very near future, and we've certainly got targets of 1,200, 1,250, and then 1,500, probably within the next 12 months, and maybe even sooner than that. The big driver, of course, with all this stimulus is the United States, where we're seeing their budget deficits of $2 trillion this year and more than $1 trillion the year after, means that a lot of bonds have to be sold, which means that their bond market is going to see at the long end rates well above 5 and 6%, not just the 4.5% that we've now got. So the American dollar will continue to weaken. Now funds will come out of the bond market, will come out of that cash mountain that is talked about in the United States, where $9 or $10 trillion has been sitting in bank deposits and cash management trusts earning next to no interest. Those funds will have to come out, and they will flow into the commodity markets, into resource sector equities, and probably also into the general equity market. We have had quite a good performance out of the US equity market more recently, and if we do get that thing testing just over 9,000 on the Dow, it certainly suggests that that equity market will be firmer for the rest of the year, and will probably confound a lot of the bears. There does appear to be a lot of institutional cash on the sidelines, where people have been uncertain and unwilling to come into the market, but I think we're starting to see those funds coming in, and people feeling a lot more comfortable. Again, from our point of view in the resource sector, we're seeing the leaders still consolidating after big moves from the lows late last year, but I do think that we'll see the BHPs and the Woodsides look much stronger as we go through. But what is of more interest is that the second liners have been performing, and a lot of the very small stocks that have been pummeled over the past 9 months, 12 months are now recovering, and we're seeing some very, very good performances there. All in all, it's an outlook which is just self-reinforcing, and I think that confidence will come into the market, and our longer-term view that last year was really a correction, and a very savage correction in a longer-term bull market for commodities, I think will be confirmed, and I am very encouraged by the way we're starting to see a lot of market breadth and improvement in market breadth, good participation by people in all areas of the market in the resource sector, particularly at the small end. So have a look at our list of recommendations, which is attached to the end of this talk. Do note that directors and their associates hold interests in many of these companies, but we back them because we believe in them, and the markets look as if they're doing what we thought they might be doing for this year. Thank you.